Hello, a very good afternoon to each one of you. I just want to say that I'm really, really glad that we are back. I don't know how many of us we attended previous My Money seminar, but wow, it's been a long 3 years since we have a big physical event like this. So I don't know about you, but I'm really glad that we are all back. Are you all glad that we are back? Okay, great. Now, previously, whenever I speak for My Money, I always say that, if you're me standing here looking at a huge audience, you don't know how nervous it is. So it always helps the speaker if you can smile a bit. Okay, that helps. Okay, otherwise it's actually very scary standing up here looking at everyone not smiling. It's very funny because when we transited into using Zoom for webinars, I got a bit nervous because I've never done that before. Yeah, now I got used to Zoom, and then when I come back and do a physical event like this, it's actually quite nervous doing a physical event again. But big thanks to Vasu. I definitely agree with Edward. It was a really good, very clear market outlook. Now, my job for the next segment is really to go a bit more specific, maybe provide some handles on what we can do in this environment, and at the same time, hopefully give it a bit of encouragement. I think we all need a bit of encouragement because it has been a really tough 3 years, and just when the pandemic is coming to the tail end and life is a bit normal, this year the markets have been really, really tough, especially if you have been investing. So the topic that was given to me this afternoon is navigating a rising interest rate environment. And notice the word rising interest rate, because we often say high interest rate. It is only high because it is higher than the last few years. This is really not high, it's a rising interest rate environment. So I'm going to start first by talking about this thing that I started talking about 3 years ago, and it's called our personal money equation. We all start with a personal money equation, for most of us. I'm going to move a bit so that you can see. I think I'm blocking the screen. It all starts with income, especially if you are not retired yet. And after taking away our savings, and after taking away our fixed expenses, whatever that we are left behind, we can spend it on things that are not fixed, variable expenses, I call them. Right? And notice that I take away savings first, because it is important to first save before we spend. Whatever savings that we have, if we invest it, compounded by the returns that we get over a number of years, hopefully that will help us reach our future goals. So there are really two sides to the money equation, the left side and the right side. Most of the time, we are all very excited to talk about the right side, because the right side is the exciting side. It is the investment side. The left side is the boring side. This is the side what I call the short-term financial planning. But this is, if not as important, or maybe even more important side, because this is the side that really helps us become rich. Because it is not how much we earn, just how much we earn that makes us rich. It is also how much we save. And this is the side that we can have better control, as opposed to the right side, which is the long-term investing side. This is the side that helps us stay rich, at least for most of us. Very few of us actually become very rich through investing. There are, most of us, this is not the side. This is the side that helps us stay rich by beating inflation. But unfortunately, this is the side that we have lesser control over in the short term. Makes sense, right? Because there's no control over how markets will behave in the short term. Vasu has alluded to that just now as well. We can guess, we can think this is going to happen, but really none of us really know what's going to happen in the future. So I'm just going to speak a bit on the right side, which is the investment side. Now, to start off with the investment side, which is the long-term investing side, I'm going to ask all of us this question. How many of us want to invest in this stock? Show of hands. Great. Okay. How about this particular stock? How many of us wants to invest in this? Show of hands. Some of us. Thank you very much. How many of us wants to invest in this particular stock? Show of hands. Great. Thank you very much. The rest of you whom you didn't put up your hands, do you all understand my England? Or you totally don't care about me? Okay, maybe you will say, I didn't put up my hands because there is no information. Nothing there, just some graphs and all that. I cannot answer you. Okay, you are the smart guy. But for the rest of you who supported me by putting your hands, thank you very much. Okay, at least I got some responses. Now, it may interest you to know that they all belong to the same stock. They're actually the same quote-unquote stock. Because if you look at the first slide that I show you, the first graph that I show you, it's actually this part where I circle. It's coming down and we don't like it. And this is actually the year-to-date performance of the S&P 500. As at last night, it has fallen about 18-19% year-to-date. And if I ask you to take a look at this and we just look at year-to-date, we don't like it at all. But then the second slide I show you, this is actually the S&P 500 5 years return. It looks better. I've got this app on my handphone that whenever I don't like the year-to-date graph, I will click the 3 years and the 5 years, and then the graph goes up, then I become a bit happier. Because that's the truth, right? In fact, Vasu showed you that just now, the long-term return of the market. So if you look at it, you said it's actually not too bad. Look at the 10-year one, which is the third slide. The whole thing is actually the 10-year. This is the 10-year S&P 500 performance. It's quite good. And if you can invest just a bit longer, the next one is the S&P 20-year return. It's even better. Now, of course, some of us here say, I don't have 20 years. Well, you have. Even if you are a retiree, you have. Because retirement is a very long time, right? And certainly you have some portions of your money that you can invest longer. Of course, some money, you need it immediately. You can't do that, I understand. Yeah, but I hope this stock, I call it, it's not a stock, it's actually an index, and you know that you can buy the S&P 500 or, for that matter, any index by buying an ETF to track the index. I hope that gives you some perspective that whatever we are going through right now, yes, we don't like it, but let's not forget that the last few years, we had a good time with the stock market. Last year, the equities market was like delivering 23-25%, thereabout. And we were very happy about it. Surely we have to expect sometime the market is going to come down. Okay, so if you can't see here, I can read for you the 20-year return over the 20 years, the S&P return about 318%, which is pretty good. So some lessons that we can take away on long-term investing. Firstly, equities generally always rise in the long run. Okay, that's the first lesson that we can take from history, and I hope that gives you encouragement. The second thing that we can take away is that in the short term, there will be volatility. It has to be, because without the volatilities, you cannot get the return. We cannot expect ourselves to invest in the stock market and expect it to be a straight line. It can't be, right? It's always going up, never coming down. It cannot be. It's the same with life. Life is always not a straight line going up. Sometimes it has to come down. But thankfully, for most of us, most of the time our life is fine. Most of us. Of course, there are some people, unfortunately, life is not too kind to them. But for most of us, most times our life is fine. So is the stock market. In fact, 3/4 of the time, the market is actually flat or up. Right? Only about 1/4 of the time, the market comes down. So we have to expect this volatility. But the question really is, what caused these volatilities? Now take a look at this. This is actually the MSCI index, world index. Right, the MSCI world index comprises of about 23 developed markets, mostly in the US. You have to expect it to be so. Right, US, Canada, and the European countries. Right, and take a look at the MSCI world index from 1970 all the way to 2021, end of last year. Look at some of these things that has caused the volatility of the market. So I can't point because the laser, you can't see it, so I'm going to just come here, right? From the left in the 1970s, right, you have the oil embargo, you see the S&P 500 came down 43%, you have the US inflation at 13.5%, so the world has gone through this before, right? And then you have, many of us will remember the Iraq and the Kuwait war, and we remember the Asian financial crisis in 1997, natural calamities like Hurricane Katrina, September 11. Of course, nearer to us right now, 2008 global financial crisis, Brexit, and of course, now the pandemic. So many of these geopolitical events, natural calamities, These are the things that will cause volatilities. It will be like that. But what I've shown you earlier is S&P 500. This is the MSCI World Index. It's beyond US. Even the MSCI World, it goes up in the long run. So I hope that gives you certain encouragement that, yeah, we just have to go through this. Of course, 2022, the problem is high inflation with rising interest rate that is causing the problem. But markets have always rewarded discipline. And if we are a disciplined investor, we look beyond the concerns of today. We don't ignore it. Yeah, we don't ignore it. We talk about it. But we look beyond the concerns of today to get the long-term returns of the market. So, what caused them? Well, many things. Now, not every one of us like volatility. So if you don't like volatilities or you don't have time to write it out, because whatever I've shown you, yeah, you have to invest for a certain period of time to be able to write it out. And if you don't like it or you don't have time to write them through, perhaps you can consider adding some bonds to moderate the ups and downs, right? The main objective of adding bonds into a portfolio is to make it not so volatile. That's the purpose of adding bonds. Okay, so if you look at these two portfolio 1, the one in blue, that is a portfolio with bonds, okay, and the one in red, that's the portfolio 100% in stocks, in equities. You will see that, of course, the 100% in equities, it gives you a higher return, but you've got to expect a higher volatility. But the one with bonds, well, it's smoother. It doesn't mean that bonds and equities go in opposite direction all the time. This year, that's not been the case, right? Both bond and equities have fallen, but bonds have fallen lesser than equities for sure, right? And therefore, it is not so volatile. And hopefully, because it is not so volatile, we can sit still and we don't get out of it at the wrong time. That's the reason why you add bonds into your portfolio, to cushion the ups and downs so that, you know, you can sit still and ride it through. But the thing about bond is this, okay? It is affected by interest rate movements. So I'm going to give you an example. Now, this is not real, it's fictitious. I'm taking it to the extreme for us to understand the concept of bonds. Right? So assuming you own a 5-year bond, A-rated, that gives you a 3% per year yield. The next day, very sweet, you buy this bond already. Okay? Interest rate goes up. A new and similar bond, also A-rated, issue, okay, will have to then increase their yield to attract new subscriber. Make sense, right? Because, well, if the interest rate has gone up, if I still issue a bond that gives you 3% interest, you're not going to buy it. It's less attractive. So if I need to borrow money from you, which is what bond is all about, right? I'm trying to borrow money from you. So I'm issuing a contract. I'm issuing a bond. I got to give you a rate that is more interesting. So I cannot issue a bond at 3% already. So let's say this new 5-year bond, which is also A-rated, is now issued at 5% per year yield, higher. And if you want to sell your existing bond, the old one, which is 3%, it's going to be very difficult to sell because there's something that's better out there at 5%. Right? So if you want to sell it, you've got to sell it at a discount. You've got to sell the bond that you bought one day before at a lower price. Because if you sell it at the lower price, the investor that buys it will get a higher yield than the 3%. Does it make sense for all of us? Makes sense, right? Yeah. That is why, okay, when there is an expectation that interest rate will go up, bond prices will fall. And this is what we are experiencing right now. This is the problem that we are facing today. So, I'm not going to spend too much time on this because Vasu has done a much better job than me in talking about this. But very quickly, it's a very ugly picture that I found on the internet. You cannot see from behind, it's a US dollar. We all know it's not just the last few years, but like the last 10 years, there have been a lot of money, a lot of printing of money, right, out there. And because of this excess liquidity, plenty of cash chasing after goods, it causes inflation, right? And of course, we have the Ukraine and Russia war, right? And because of the war, that has affected commodity prices. Ukraine, if we do not know, I did not know until the war started and read up a bit about Ukraine. They are the #1 exporter of natural gas, if I'm not wrong. Okay, top 3 definitely for oil, they also export things such as corn, sunflower seeds, and all that. And because of the war, supply has fallen. And because supply has fallen, prices go up. Makes sense also, right? So inflation has gone up. And of course, we have that very ugly COVID virus there affecting supply chain. China is still not out. I mean, they are still adopting the zero COVID. And if you do not notice already, if you buy things from Shopee, Lazada, it takes longer than last time for your things to come because of supply chain disruption. All these things has caused inflation to go up, right? And because inflation has gone up, the governments around the world has to increase the interest rate to fight inflation, right? Because hopefully through interest rate going up, people will be less tempted to borrow, and hopefully people buy less things, demand drop, and then you get inflation slowly coming down. And so we are in this environment right now, whereby governments around the world are increasing the interest rate to fight inflation, of course led by the Fed in the US. So what are some of the short-term effects of a high inflation? So I hope that gives some clarity of the current environment that we are in right now. But I'm going to bring all these things together and tell us what are some of the short-term effects of a high inflation and rising interest rate environment. So when prices go up, things such as food, raw materials, petrol, and others, it goes up, the price goes up, right? And if you're an individual, we're all individuals here, it just means higher expenses for us. Higher expenses means less surpluses and lesser money to spend. Makes sense, right? If you're a company, it just means higher cost of doing business because raw materials have gone up. Coupled with lesser consumer spending, companies will not do as well, lesser profits. Makes sense. From the economic standpoint, that can lead to a possible recession because everybody is spending lesser, right? So these are the implications. Now, in a rising interest rate environment, savings rate go up. We have all experienced that. So now FD rates are like almost 3%. Your Singapore savings bond is in excess of 3%. T-bills, the last one, the cutoff yield is about 4.19%. How many of you bought this? Congratulations if you have bought them. I bought them for my wife as well, and she was very happy that I told her that she got 4.19%. Divided by 2, of course, 6 months. Yeah, so everything has gone up. Your savings rate has gone up. For an individual, that will encourage a lot of us more to save, right? So all of us right now are looking for higher FD rates. Banks that offer higher FD rates, you move your money there, you are applying for T-bills. Before this, none of us have heard of T-bills, right? Now everybody is talking about T-bills. It's probably the most popular thing in town right now, more popular than your bubble tea, right? So savers, more savers, less spender. Companies, because consumers are spending lesser, again, lesser profit and possible recession. I hope you can see it. I'm going to move aside. Okay, but on the flip side, the bad thing is with interest rate rising, loan rates have gone up. Mortgage, even car loans, business loans and all that has gone up. Again, for an individual, that translates to higher expenses, lesser surplus, lesser to spend. For the companies, same. Companies do borrow money as well. Higher costs, coupled with lesser consumer spending, lesser profit, possible recession. So what I'm trying to do here at this table is really to put the different things together and to show you the effect on its implication to individuals like ourselves, to companies, and to the economy. And as a result of this, equities prices, they have fallen. But what that means also, which again, I'm just repeating what Vasu has said, is that the expected returns have gone up. In terms of bonds, prices have also fallen, lesser as compared to equities, but they have fallen as well. But it also means that your yields have gone up. I'm not sure whether that's good news for you, but it should be good news. Don't you think so? No. Okay, I'm going to ask that again, okay? Don't you think this is good news? Okay, I'm glad I hear a soft yes. My English is fine. Because if you are buying things, you want to buy in a sale, right? You don't want to buy things when it's expensive. I know if you're invested, you feel the pain. because you're experiencing the volatility. But I hope the charts that Vasu and myself have shown you would have encouraged you that, well, it is temporary. The world has to go through this. The stock market has to go through it. So if you're invested and you don't need the money immediately, it's going to come back. But if you have yet to invest, or you have some monies to invest, or you are retirees about to invest, you're spoiled for choice. Because you have got cheap equities to buy, bonds that you can put in with a higher yield, plenty of saving options. Now you don't know where to go. FD, T-bills, SSB, and all that. Isn't it exciting? I'm just trying to make you all a bit happy. Because it's financial talk can be quite boring, right? So how should savers and investors respond? Equities have fallen, bond price have fallen, expected returns have gone up, yields have gone up. So if you are an existing investor, you have already invested, and you are an accumulator. An accumulator is someone that is still saving, right? You are not retired yet. I'm checking my time. I'm very mindful of time, right? So you are not retired, so you are still accumulating. These are some handles I can provide for you. Let me just say this. This is an MES event, so I need to say this. Please, this cannot be constituted as advice. Because all of us, our specific situations are different. Please speak to your trusted advisor before you act on anything, okay? This is just general, right? General. So if you're an accumulator, right, stay invested. This is not the right time to get out. Keep investing. If you have got spare cash, keep investing, top-ups, do regular investment because you are buying things cheaper, higher expected return, higher yields. Optimize your cash because there are so many options for you, right? The FDs, the SSB, T-bills. Optimize your cash. And you might want to explore investing some of your OA monies into T-bills. The break-even point for a T-bill is about 2.9. For OA money is about 2.9%. If T-bill is about 2.9 or 3%, you can explore, I'll say explore, okay, because I'm not sure whether the OA interest rate will go up. Because as we all know, your ordinary account interest rate is pegged to the 3-month average of the local bank's interest rate. It's a basket of the savings account interest rate and fixed deposit rate. Okay, to be exact, 20% of the savings account interest rate, 80% of the fixed deposit interest rate. And if this interest rate goes up, your OA might go up, right? Yeah, but as long as the T-bill, okay, is at this current region about 4%, I think it's fine. Okay, explore. Okay, I'll say explore. And if you are new, I saw some of the younger people coming in, and that's really encouraging. And so you're just starting, you're beginning your investment journey. If you are new, this cannot be a better time. Consider investing. Higher returns, higher yields, but do use low-cost instruments such as exchange-traded funds or low-cost funds because cost is of paramount importance when it comes to investing. You buy something that's very high cost, it will eat into your returns. How about for retirees? There are many retirees in this room. And for retirees, you are my biggest concern because we don't have a lot of time and you may not have any income. So I'm going to speak to you all for a while. So for retirees, if you are already retired, okay, and you have invested, yes, you can explore. You may have monies in your OA. Please don't take out cash from OA and buy T-bills. Please don't do that because when you take out cash from OA and then you go and buy T-bills, when the T-bills mature, it comes back as cash. And then there's no certainty whether the T-bills is going to be at this rate 6 months later. You want to put back into your OA, you can't put back into your OA anymore. So if you want to explore investing your T-bills from your OA, do a CPF-IS investing from your OA into T-bills. If you have cash, optimize your cash. And some of your bonds, if you have bought bonds the last few years and it has matured, again, spoiled for choice, okay, you can buy new ones. Rebudget your expenses needed in the next few years because we do not know whether this situation will persist for the next few years. Things are uncertain. You may want to rebudget your expenses and spend a bit lesser. Take profits from portfolio when money is needed in the near term. So you have portfolios that the money you need in the next few years, and because of the last few years of the very good returns from the stock market and you have profited already, you might want to take some money off the table because if you need the money next year, there is no certainty where the markets are going. Okay, preserving it is key. But for the portfolios that you are investing for the long term, you don't need it immediately, right? You only need this money in the next 10, 15 years. Do remain invested because the markets will come back. For retirees who are you are just retiring and now you have cash, right? And you are thinking about how to invest your cash. Like I said, it's really exciting. You do all the above, but you may want to apportion your retirement fund into near, medium, and long term, right? So let's say if you have got a sum of money, say 500,000, a million, I do not know how. Usually they say that the minimum requirement to sign up for my money event is $1 million, right? So you're all here, you're all millionaires. Okay, no such rule. Okay, sorry, just joking. Okay, but whatever money that you have, okay, what I'm trying to say is you apportion, I've got 5 minutes, right? Yeah, okay. So you apportion your money, some into short term, because monies that you need in the short term, the next few years, please don't invest that money. Please keep it in cash. Monies that you need it in the medium term, yes, you can invest, but have more bonds than equities. But monies that you don't need in the next 10, 15, 20 years, well, you can consider investing into equities because this is a good time. So I'm going to end with the financial planning side. Because I've spoken a lot about the investing side, I need to talk a bit about the financial planning side of the equation, especially for the younger ones. Whatever we have been sharing with you, whatever Vasu has been sharing with you, is like a weather forecast. The weatherman is not always right. But if you need to go to work, you go to work. Make sense? You are not going to listen to the weather forecast and say, I think it's going to rain, so I don't go to work. You call up your office and say, the weatherman says it's raining, so I'm not going to work. Your boss will say, goodbye, don't come back again. Well, the weather is just to prepare us as we go out to work. So if you are still accumulating, maybe this is not the best time to change your job. Please make sure that you have emergency fund because the next few years can be tough. Having that emergency fund is important. If you have got cash, monies in the emergency fund especially, you can optimize it by using either FDs, SSBs, T-bills. You might want to re-budget a bit because things are getting expensive. So you may want to budget and see whether there are, ways to lower your expenses. Be prepared for high expenses in mortgage repayments, that's for sure. And if you have cash and you're not doing anything about it, you might want to consider repaying your loans, especially if the loan rate has gone up so much. Right? Small loan amount, you got cash, you're not investing it, you might as well repay your loans. And review your insurance portfolio. Please make sure you are adequately and comprehensively covered because if you are not and the markets are coming down and you need money, this is the worst time to be selling off from your portfolio to fund your medical expenses. So make sure you are adequately and comprehensively covered. If you have got insurance that are unnecessary, get rid of them because some of the insurance you may not need it. And reduce premium payments if possible to have more surpluses. The last slide I'm going to show you is this. In every crisis, there are things that we can learn. I learned from the 2008 GFC. In the 2008 GFC, my financial position was not as good because I started my firm in 2001. And usually as an entrepreneur, the first few years is very tough years for entrepreneurs. And in 2008, I was really nervous. But today, I'm in a much better position. Today, my mindset of the crisis is I'm looking for places to park my money. So don't waste a crisis. There are a lot of things we can learn from a crisis. But if this crisis has taught us anything, it's firstly, please spend below your means, not within, below. Within means you earn $1, you spend $1. Within, okay. Below means you earn $1, you can spend $1, but you don't need to spend $1. That's the first lesson we can take away. Spend below your means. Secondly, avoid unnecessary loans. This quote-unquote crisis has taught us that interest rate is not always low, right? And thirdly, always have sufficient emergency fund. I just want to end with a story, then I'll come down, okay? Because they're showing me 1 minute already. How many of us, we have watched this documentary series on Netflix called Take One? Anyone? Take One? It's a Korean documentary. Okay, I'm here to promote Take One. It's a series of documentary that gave a chance to singers in Korea one take in their lifetime to present their best song. And in episode 3 of Take One, now I'm not a Netflix craze, but my wife asked me to watch it, so I watch it. In the 3rd episode of Take One, they featured this singer by the name of Yim Jok Bun or something like that. Yeah, and he was a famous rock singer in Korea, but suddenly after his last concert in 2016, he disappeared. He went on a hiatus for 6 years. They found him again this year, beginning this year, and what happened was that in the last 6 years, his wife died, his father died. He has to take over the role of a caregiver for, and to, as a parent, the only parent for their daughter, and he shared that he was coping with the loss of his wife, and by the time he take care of his daughter every morning, send the daughter to school, clean the house, he's tired, that he has no mood for anything. He was really in a bad shape. He's really a very good-looking guy, but when they found him, he was really in a bad shape. They got him to agree to do this take one, and he invited a very small audience, about 10, and all of them are actually those frontliners fighting COVID in Korea. And COVID, we all know, was very bad in Korea. Until now, it's still quite bad. The song that he sang came from one of his albums, and that song is "These Too Shall Pass." I was very encouraged when I watched this particular episode. When he sang the song, he cried, the audience cried, my wife cried. I look at her, I better cry. Otherwise, I'm emotionless, right? But, well, whilst the song talks about a person being there for him, and this person is no longer around, I thought it's a really meaningful song because I don't know what personal challenges we face in life. Surely it cannot just be about the financial markets, right? We have personal challenges, but yes, the financial market can be quite challenging, but like in all markets, these too shall pass. Right? We just need to make sure that we go through this period, and hopefully some of the things I share here provide some handles for all of us. With that, thank you very much.